This conference will now be recorded.
Good afternoon and welcome. Welcome to the Clear Lines training session. I am your host, Kipp Cohen. Today is Thursday, the 24th of September, 2020. This is a special training session on money management. I conduct these sessions every Tuesday and Thursday at 3 o'clock Eastern. They are geared for the subscribers of Clear Lines and Equity Alerts, or for those that have interest in learning more about what we do with at Equity Alerts and how to use the Clear Lines indicator on the MedBed Trader platform. If you have questions during the session, I do ask that you submit those through the GoToMeeting chat box. Oh, hold on a second. Somebody was not muted. Let me turn down the mic, the speaker. Yeah, submit your questions through the GoToMeeting chat box. If you have a specific question outside of the session, you're always welcome to email me or text me or call me, kip@equity-alerts.com, and my phone number 972-841-8886. So the reason I decided I kind of wanted to have this conversation today, obviously, I think it's important every once in a while to remind ourselves of the importance of money management and position sizing and risk tolerance. You know, we're so focused during the day on our trading, and most days everything's great, but there's always that one time where you get into a trade and something bad happens. The market makes a rapid change in direction. You think it's going to turn, you add on, and then before you know it, you're over leveraged. And I'll tell you, leverage is a double-edged sword, because it's good when it works in your favor, and it's horrible when it goes against you. I have some. I'm going to go through. I actually have, believe it or not, I found one of my old PowerPoints that I did when I was at Wise Trade on money management, right, and stops. So I'm going to kind of go through some of that and talk about it, and then we're going to focus more heavily on one of my key points, which is my 10-10 rule, which is actually on one of my. I have a sheet called 10 Simple Rules to Trade By. There's a lot of things on it, but it's the trading rules to follow by Kipp Cohen. And actually, I'm going to share this real quick. I'm going to show this to you guys. And if anybody wants a copy of this, if you don't have a copy of it and you would like a copy of it, just email me. Send me an email, kip@equity-alerts.com, and just say I want a copy of your trading rules, and I'll send you this. But some of the key points, as many of y'all know, I've been teaching traders for over 20 years now. I've educated thousands of traders. Following these simple rules definitely will help you to become more successful. When you're using the right tools and follow a well-developed trading plan, there's no reason to fail. So first of all, I came up with an acronym called Fat Cats, which I think is just kind of a good general rule to follow. F being follow a trading plan. Have something. Have some kind of rules. Okay. And I don't care, you can develop the plan however you want, but have some rules. Know your risk tolerance, where you're going to set your stops, where your targets are, how much you're going to put into a trade. And that's a whole nother development of a trading plan is a whole nother session. Uh, the A in a fat cat is accept and limit losses. That's important. Look, loss is a part of trading. Um, it's limiting that is critical, and just accept it. We're going to have them. It's okay. You're not you're not going to kill yourself taking some small losses. And y'all see my trades every day. You see posted what I do in the on our website. I'm not the greatest trader in the world. I'll be the first to admit that. What I'm good at, I'm good most of the time. I'm good at cutting my losses. But today was a great example. I had, what was it? 1, 2, 3, 4, 5, 6, 7 winners and 6 losers in a flat. I mean, I was just barely a little over 50%, but it was still a winning day because I cut the losers and I let the winners run. All right. Trust your trading tools. That's important. The trading tool that we use, the clear lines on the MedBed Trader platform, right? With pivots and the bands and the fib levels. And I mean, those are our tools. And y'all use a tool. That's me, Jim, and Lindsay. We are your trading tools. We're here to help you. Um, control emotions and be patient. So I always know one of the areas I have to work on is patience because I'm not always the most patient person. But as a trader, it's very important not to don't let emotion rule you. Don't get freaked out. You know, it's okay. Look, if you lose a little, you get back in and you make it back. You are doing the next one. Always educate. It's important to continue to educate yourself. I know Jimmy. Jimmy loves to educate himself. He's always out there looking to learn something new. He's even here today, looking to learn something new. Obviously, timing. Timing. I'm going to say it's. I used to say it's the key to success. Timing's important. It's not everything. Timing. Getting in, getting out. Yeah, that's important. It's not. I should change it. I just to say, you know, timing is important. Let's just go with that. And we'll leave with add on to that not to chase. Don't go chasing. Maybe I should add that. But let's change this. Timing is important. Don't chase, right? And then obviously stay focused, disciplined, and decisive. You guys know I have some days where I'm not focused or I'm just not right, and I know and that's when I have to step away, and that's okay. Sometimes you have to do that. Sometimes you got to step back and not trade for a little while. Could be a couple hours, could be for a day or two. I decided to take a week off because I needed a break about a month or so ago. Um, the next thing is you want to try to stack the odds in your favor when you're trading, or as I call that, you're lowering your risk. So there are, and I'll admit we don't always do this, but to increase, I think Jimmy's gotten better about this. Jimmy likes to trade with the trend of the market. When the market's going up, Jimmy's usually going long. You know, Lindsay and I, when the market's going up, we're usually looking to short it. But trading with the trend of the market will improve your odds. Trading with the trend of the stock will improve your odds as well. So it's like in the morning when I say, all right, this is a possible choo-choo. It's because it's a strong trending stock, and I feel like it's going to be a good trade to go long. Go with the trend of the stock and trend of the market. Avoid common pitfalls. That could be a number of things. Pitfalls would be like chasing a trade, not checking volume, trading wide spreads, illiquid stocks. Just some of the common mistakes that could be made. Use good money management. We're going to talk more about that. We used to use the term fast, fresh cross angle separation, timing. We don't quite use that terminology, but that was always an important one as a wise trader. Always follow a trading plan. Again, have some kind of plan in place. A plan to get in, a plan to manage, a plan to get out. You can use fundamentals if you want. That's really geared towards the longer term traders. That would increase your odds. And I do agree that positive attitude is everything. Being positive, being in a good mind, mentally ready, makes it easier to trade. When you're in a bad mood or in negative thoughts, I think it's harder to trade. So let's take it a little deeper. So this is a way back, but I had received an email from a trader that was expressing frustrations with his trading. He had been trading for about a year and was not achieving consistent results. Based on what he told me about his experiences, I decided to write him a simple set of rules that I thought would help him regain focus and to allow him to achieve his goals. Trading successfully does not occur overnight. For some traders, it takes a year or two of education, practice, and patience to gain consistencies. I look at it this way: learning how to trade is like going to college, yet it can be much less expensive and the learning curve is usually a bit quicker. Everyone learns how to trade at a different pace. Some find their groove quicker than others, and that's okay. What is most important is that you don't shortcut the learning process and you follow the rules of your plan. All right, so this is really geared towards the newer traders. Number one, stick to one or two. Well, it really could be anybody, but definitely for the newer traders. I always say for the newer traders, stick to one or two strategies and learn them well. Okay, like poppers and droppers, right? Trading the poppers and fill and fade the gap. We kind of that's pretty much what we do. We trade the poppers and droppers every day, and then we fill and fade gaps. We look to trade off tops and bottoms. That's most of what we do every day. I don't vary off of that very much. And by other strategies, swing trading, position trading, um, options, future. There's a lot of there's different active strategies. I used to have um, reverse the burst, which is an example of a fading a gap. But just try to become an expert in one or two strategies. Number two, develop a simple trading plan that describes exactly how you will enter and exit your trades. It should clearly define your goals and your stop losses. You should know exactly how you want your charts to look like, and you should journal your trades. Plan out every trade. Do not vary from that. So how do you journal? Well, you can do screenshots, hit the print screen on your keyboard, take screenshots when you get in, take screenshot when you get out of the charts. So that way you can go back and look at it later and figure out what you did right and what you did wrong and take notes, right? Actually, Medved has a built-in function to be able to do things like that. If you right click you can print or share a chart. You can email it, you can text it, you can save it, clipboard it. So you can, right? I can do that within MedVed. That's a great thing about this system is it lets you do that. I just hit the print screen on my keyboard. Like I take screenshots all the time. All right. But that's important. That's good to go back again for the newer traders and even some of y'all that have been doing it for a while. If you're having a rough patch, start looking back at your trades and try to analyze, okay, what did I do right and what did I do wrong? What happened? Why didn't it work out? But develop some kind of plan. Okay. Have a set of rules. Once you've developed your plan, follow it, right? Sounds easy, but many people create a plan yet never follow it. So stick to your plan. It's good to paper trade it until you're consistently achieving your goals. So as you're developing your plan, practice trade on it or trade real small. You could, I mean, you could trade 10 shares while you're building your trading plan to validate it because you need to validate it. Once you go live, again, this is for the newer traders, start small. Consider trading, and I should actually say 10 to 100 shares, right? Or maybe 10 to 50 shares, really. When you're first starting, 10 to 50 shares at a time. Gradually increase the number of shares traded until you reach the amount you ultimately plan to trade. I can't tell you how much exactly because we all have different account sizes. We all have different risk tolerance, but it's good to start small and build into it as you're getting more comfortable. This is one of the ones that I really wanted to focus on today, and we're going to spend some additional time. Consider using the 10-10 rule, okay? Meaning never use more than 10% of your account in a single trade and never have a stop greater than 10% of the position. This can limit your losses to no more than 1% of your account unless something catastrophic was to happen. So the only time something catastrophic could happen would be either A, the stock halts in the middle of the day and bad news comes out, or B, you hold overnight and something between sessions happens. Okay. That's what I mean by catastrophic. So in that world realm of the 10-10 rule, that's ideally going to be for somebody that swing or position trades, okay, using 10-10. So if you have a $100,000 account, right, and you're swing trading or position trading, your positions should be really no more than about $10,000 with a 10% maximum stop loss. That way, if something dramatic happens, you're going to limit your loss. Now, active trading is a whole different ball of wax. I would still follow that rule, but to a different level, okay? In other words, you could theoretically put 100% of your account in a single position. I wouldn't encourage it, but I know some of y'all probably do, especially when you're using margin. What would your stop loss be in that same scenario? Your maximum stop loss. No. What percent? If you put 100% of your trade, if you put 100% of your account into one trade using the 10-10 rule, 10-10 rule, but readjusting it to what I said, remember, limit losses to a certain amount, 1%, right? If you put 100% of your account in a single trade, then your stop loss better not be greater than 1% of that trade, right? $1,000. If you have 100,000 in the position, you should not risk more than 1% of that position. So the variances would be, okay, well, if I want to trade a little bigger during the day, if I want to put 20% of my account into a position, then where would my max stop loss be of that position? If I put 20% of my account, where would my max stop loss be? Come on, guys. It's twice as much as 10%. If you're putting 10% with a 10% stop, 20% would be a 5% stop, right? No more than 5%. If you're putting 25% of your account, 4%, right? You get the idea? I'm just giving you a general rule of thumb, okay? This is a rule of thumb. So I know some of y'all like to scale in and scale out of positions. If you're going to scale into a position and you're ultimately going to put 10% of your account or even 20% of your account in that position, if your ultimate goal is to put 20% of your account in that position, start with 5% or 7%. And then you have room to add. You could add 4 or 5%. You can add another 4 or 5% to get to that 20. Or if you're trading, if your rule says I don't put more than 10% in, start with 5. So you would, if you have a $100,000 account, you put $5,000 worth of that stock into that position. Then you could add another 3% or 3,000. You could add another 2,000 to get to the 10,000. Okay. But I'm not here to tell you you have to follow this exact to the T. You have to decide where your risk tolerance is going to be. You ultimately have that decision. For me personally, and I trade different than, yeah, it's your comfort level. You have to decide your comfort level. Because I know for a fact it gets very uncomfortable when you got a big trade that goes against you. It's no fun. If that hurts and that doesn't feel good and you don't like what it makes you feel like emotionally, don't do it. You don't know it till it happens, and it takes, you know, one good smack where you wipe out 2 or 3 weeks of profit to realize, oh crap, maybe this is not for me. Maybe I need to make an adjustment. You don't really know it till it happens. And then once it happens, you have that oh crap moment. And then you're like, okay, I need to scale back a little bit on my position sizing. I need to come in with a little smaller position, or I need to cut my losers quick. You know, you kind of have to pick and choose. Look, Jim and I and Lindsay all trade a little differently. And I think it's actually really great because it lets you figure out which method is the best for you. I like the way I trade. I like cutting the losers as quick as I can, which I do most of the time. I sometimes try to let them go, and that, you know, I don't like the way it feels when it goes against me. But, you know, look at the difference in the results between Jim and me. Jim's results are much better than mine because he is willing to let things go a little further, carry them a little longer, be a little more patient. You do let trades move against you. Yeah, Jim will let trades move against him. I don't like, look, if I'm down 15 or 20 cents, I'm like, forget it most of the time. So I can't tell you which one of us is the best method because we're all different. They all work. I mean, our results speak for themselves, but do they work for you? You only you can answer that question. So, um, and you'll have to kind of play with it. You'll have to make adjustments in your trade sizes. I think Lindsay's pretty good. He takes smaller size positions. You'll notice. And lately, most of my positions have been really small because of the market, because of the volatility. You know, I I will when I trade Amazon, I trade 10 shares. When I traded Twilio today, I only traded 50 shares. I just because of the spreads, because of the volatility. I'm just not I'm not that comfortable with bigger positions because of the movements we're seeing. Joe says, isn't a lot of that account size also not to get personal, but it seems like Jim might have a rather large account and with the way he holds some of these. It's I'm going to say it's a combination of things. It's a combination of risk tolerance. It's a combination of account size. It's a combination of experience. Jim's been trading a long time. Jim has a bigger pain threshold. Jim, you know, but I think both you and Jim and Lindsay don't mind holding for days at a time, or weeks at a time, or months. I mean, remember um, um, what was the TVIX? Y'all held TVIX forever. That was a horror. I again, that it's you kind of have to decide who you are as a trader. Um, I feel better if I, you know, in, my active trades are active trades. I'm out at the end of the day. My position trades are position trades. I don't worry about those, right? Are you you're referring to your net liquid cash out account and not your day trading? So, I mean, depending on your broker, you may have 4 times the buying power. That's margin. Okay. I'm talking about of your actual liquid cash when I'm talking about this, not the margin level. Your cash. So if you want to push up because of margin, that's your choice. I mean, like I was saying, margin's a double-edged sword. So um, when you're really where this comes in the biggest play is when you hold something overnight. Okay, that's where you can really get dinked hard. If look, if you've got something going against you and you're trying to hold it, it might make sense to peel back some of that position, let some of it go so you're not over leveraged. Jim has a larger supply of Malox. Yeah, he's got a whole shelf full at the store. All right. Number 7, never force a trade, let it come to you. Forcing trades creates losses. That's that whole what I was talking about. Don't chase. Wait for it, you know? Jamie, you forced one earlier, didn't you? You got it in a little too quick on OMI, or you were late. You were late. Did you end up losing on that? $7. Okay. But that's what happens when you don't when you force it or you're late, usually it ends up as a loser. Um, yeah, Paul, if anybody wants a copy of this, if you just email me, I'll give you a copy of this. Oh, the questions. Yeah, I don't, you'll be able to, I'm in playback, you'll just be able to hear what we've discussed. Number 8, only trade what the market will allow you to trade. There will be times when certain strategies don't work. You must be in tune with that, right? There are certain periods where certain like this has not been a swing trading market. It hasn't been for a while. Or, we used to do the Charlene's. You can't do that strategy. You must be focused, disciplined, and decisive. Keep your emotions in check. If you lose focus, step away from the mouse and take a break. Right, Jamie? Most important, you must limit your losses and let your winners run. I have many days when my win-loss ratio is 50-50. It's not as many as it used to be, yet I still reach my goal. Here's an example of one of my trading days. Out of 10 trades, 4 were winners, 1 was a flat, 5 were losers, yet I was able to achieve a 1% return on my account. The reason was that my losses were small. I firmly believe there are 2 sides to every trade, and you know very quickly if you are right or wrong. If you're wrong, be gone, right? Sometimes I tell you that. I'm like, I don't like what I'm seeing. I'm bailing out. If I don't feel comfortable, I'm not afraid to bail out. And I'm going to show you, here's today's trades. This is an example of money management, right? So my first trade, I lost 23 cents. Then I came back, made 54. Then Microsoft, I let Microsoft go too far. That was too far for me. $1.26 was definitely way too far. I don't like to let it get away. Picked up 206 on Nvidia, 27 on Penn. Actually, my day, if it wasn't for Microsoft, should it be another dollar higher day? I should have cut that after about 25 or 30 cents. Goler, I lost 13. Penn, I lost 22. AMAT, that was my flat trade. A penny's flat. Goldman, I picked up 58 cents. EXAS, I picked up $1.01. I lost 20 cents on Walmart. Picked up a quarter on SGMS. Lost 16 on Jabil, and I picked up $1.61 on Twilio. So you'll notice most of the winners ran. All but one loser got cut really quick. I think I kind of got blindsided by Microsoft. But that's a great example of where you can be basically almost 50-50 and still have a successful trading day. Jeff says, understanding everyone is different, has different goals. What should a reasonable goal be for a day for new traders? Um, 100 bucks, that's a reasonable goal. 150, 100 to $200. I mean, $100 a day, that's $500 a week. That's 2,000 a month. 200 bucks a day, that's 4,000 a month. So hold on a second. Sorry. How can I get to 5K a day? Big account, big trades. Oh, he's kidding. Jim says, follow me. I'll tell you, I mean, we have traders in our room that probably are at that level. Brent, but Brent's trading a big account. I don't know exactly. I'm assuming it's probably a 7-figure account based on the size of trades that he does. But he's got a big account. He's got, he cuts his losers quick too. He's very disciplined. He's very, yeah, experience, all that. The key is to just build consistency. Y'all know this one. I'm just going to kind of zip through this. We've talked about it many times, but there's 5 possible outcomes to every trade, right? You either have a big winner, small winner. This was from Chris Irvin. He used to work with us. I don't, this was his. He wrote it. At least I assume he did. Um, anyway, five possible outcomes to every trade, right? Big win, small win, flat trade, small loss, big loss. The the one possibility that can destroy your account is the big loser, right? Um, the best protection from the big loser is a wisely positioned stop loss that limits your exposure. In the book Millionaire Traders by Kathy Lean and Boris Schlossberg, there's an interview with a trader referring to himself as Indy Jones. His claim to fame was that he took $25,000 trading account to a million before he was 30. On page 210, he gives his thoughts on risk. The number one rule in trading is the same as the number one rule in boxing, which is always protect yourself. No capital, no trading, no life. He states succinctly. So how do you protect your capital? Always know your worst case scenario. Before you place the trade, figure out what you're willing to lose in terms of points, ticks, dollars. Check your risk reward ratio. Make sure that no one trade has the potential to destroy your entire account. As a general rule of thumb, Indy Jones does not like to lose more than 5% of his equity on a single trade. He may have been a Forex trader. This way, even if the trade becomes a loser, he can still survive to trade another swing at the market. Indy is eliminating the big loser. Once the big loser has been dealt with, you're left with 4 possible outcomes, right? It's big winner, small winner, even flat trade, or small loser. With those 4 possibilities still in play, logically, how does our trading work out? With average ability to recognize proper entries, your small winners and small losers should cancel each other out. If that happens, you are left with 2 possible outcomes, big winner and a flat even trade. If these were your only 2 outcomes you had to deal with in your trading, do you think you could make some money? Right? So here's the example I already showed you right here, right? There were 1, 2, 3, what I would call big winners today. There were 1, 2, 3, 4 smaller winners. There was 1 flat. There were 1, 2, 3, 4, 5 small losses. One I would call a little bigger. So again, had I cut that one a little quicker, my profit would have been a lot better. Should have been $5 today, not $4. But this actually is a perfect example of what what I'm talking about. Take a picture of that, right? Here, I'm going to, whoops, I'm going to copy and paste those into that document. Where's that document? Hold on. One second. Uh, um, Okay, there you go. Whoops. Okay. In your trade examples, are you trading the same number of stocks in each trade? No, there are some variations in trade sizes. Most of the time, I'm trading depending on the stock, the 50 to 100 shares, depending, sometimes higher, sometimes less. Um, Depends on the size of the position. Like I said, lately I've been trading a lot smaller because of the market volatility. All right, I want to do. I'm going to go kind of zip through this. This was a presentation that I did. Let me see if I can get this to run on this computer. All right. This was a money management presentation that I did a long time ago when I was with Wise Trade. Um, Obviously, and I'm gonna kind of just zip through some of this, but we'll go through real quick. Risk to reward. We talked about eliminating big losses, importance of stops, the different types of stops, risk tolerance, um, different stops for different trade styles, how to manage them. So, what is risk to reward? The concept is real simple. In each trade, your reward or gain should be greater than the amount you risk. So, in other words, if you're using a 1 to 2 risk to reward ratio, you risk 100 to make 200, right? And you hear me talking about that, especially when I'm placing bracket orders. So here's an example of how that works, right? So if you use 1 to 1, like you risk 100 to make 100, all right? After 10 trades, if you're 50% accurate, you break even. You don't make any money. If you're 60% accurate, you end up 6 winners, 4 losers. You make a couple $100. 70% accurate, you make $400, and 80% accurate, you make 600, right? At 1 to 1.5, you can be 50% accurate, so you're risking 100 to make 150. So at 50% accurate, you make money, 250. At 60, you make 500. At 70, you make 750. At 80%, you make 1,000. That's after 10 trades, again, risking 100 to make 150. And then if you use a 1 to 2 risk to reward, which you can't always do, but then at 50%, after 10 trades, you're up 500. At 60, 800. At 70, 1,100. And at 80, 1,400, right? What you want to strive for is to be somewhere in this 1 to 1.5. You're going to have some 1 to 1s, you're going to have some 1 to 2s, but average of all your trades at the end of the day should be in the 1 to 1.5 range. Okay. So like Jim, because he's got a high level of accuracy, Jim can afford to do more 1 to 1 trades. Most days, Jim is 90+% accurate, 90 to 100% accurate. He can do 1 to 1s. I'm more like a 60 to 70% accurate. So I need to be down in this level, 1 to 1.5. I mean, I can be down here, but I need to be up more closer to this, right? Average 1 to 1.5 or better. So depending on the type of trader you are and your risk tolerance, you may want to consider striving for an average 1 to 1.5 or better. Okay. You can have some 1 to 1, some 1 to 2, and even 1 to 3s, but most important is 1 to 1.5. That's critical. Jim does tend to add on. That that helps. It is a different style, definitely. Um, we talked about the elimination of the big loss. I'm not going to repeat all this, right? We already covered all that. So here's the importance of the stop loss, right? Why should you have a stop loss? Stop loss order is in essence an insurance policy on your hard-earned money, protecting it against possible catastrophe. The greatest thing about a stop loss order is it doesn't cost a dime to place it. It only costs you if you need to use it, right? You insure your house, your car, and your life while you're not insuring your money. And we all know what a stop loss is order, right? I mean, I don't think we need to spend too much time. You play as an order basically to sell at a certain price. So Dan asked me if I would show how to place a stop and a limit on a trade. I don't have anything really. Hold on. Let me. I don't mind. There's less than 10 minutes left. Let's. Um, I mean, y'all see me doing this every day, so I'm. Oh, darn it. Hold on one second. Yeah, no, it's okay, Jamie. Let's just for now. Let's just go with this. Joe says if we're following Jim, we can't expect a 2-to-1 ratio on the first entry. No, I mean I don't. Look, I don't know exactly what his ratios are. I would have to see because his risk tolerance is a little deeper. So his risk tolerance is probably more like a 1-to-1 because he's willing to risk more. But he can afford to do a 1-to-1 risk to reward because he's got a higher level of accuracy. That's my point. Okay. Um, and then we all know the difference between a stop loss, a stop limit, and a trailing stop. Stop loss triggers a market order to immediately sell your security once that stop price threshold is broken. Standard stop loss order guarantees you're going to get filled. It does not guarantee what price you will get filled at. Guarantees filled, not price. In a situation where stop gaps down, you could be sold at a price substantially lower than where your stop was placed. That's if you place a GTC stop loss on an overnight hold, and then it gaps down, and then at the market open, you might get stopped out at a lower price. These are old Wise Trade charts. Stop limit is basically two orders in one. You have a stop price and then a limit price. Right. Stop limit order triggers an order to sell your security at the limit you set once the stop loss price threshold is broken. In essence, there are two parts, the stop and the limit. The problem with this is that it doesn't guarantee you're going to get filled. So let's say you owned XYZ at 30, wanted to set a stop limit. You might set a stop at 27.95 with a limit to sell at 27.79. If it dips below 27.96, you would then have a limit order to sell at 27.79 or better. I don't ever use stop limits. I'm not a fan of using the stop limit. Problem with the stop limit is that it only guarantees your price or better. It does not guarantee your order will get filled. In situation where there's stock gaps, your limit might get triggered but not filled. So I don't like those. And then a trailing stop, which we talk a little bit about, that's basically automatically adjusted trails down with your order or up, depending if you're long. If you're long, it follows behind it. It ratchets one way, not the other. The biggest problem with the trail is if you set it too tight, you might, and the market's volatile, you might get it snapped out real quick. Generally speaking, you only want to set a trail if you've reached a goal, profit goal, and you're just trying to eke out a little bit more money. Key factor that you'll need to determine when setting a stop loss is your own personal risk tolerance. We all have different levels of risk we're willing to take. The strength of the trends should be considered when calculating risk tolerance. The riskier the trade, the better the reward should be, right? If you're trading against the trends or with weak trends, you'll want to make sure that the trade has the potential to permit a bigger reward. So sometimes you hear me talk about when I look at where VWAP is and I'm like, oh, darn, VWAP is too close. Like, because that's my possible target. It ends up being a bad trade. So looking at where the potential target is, like a good example today was with when I traded Twilio, that we had two good targets. We had the one target at VWAP, which was way down, which was like 5 points away, and then there was another target that was nearly about 2 points away, which was at that fib support level, and that's where I ended up getting out, which was almost $2, $1.61. But I said I was risking almost $1, so I was risking about 80 cents, I believe, or was it $1? It was somewhere around there. So my risk to reward was right in line, right? It was definitely 1 to 1.5 or better in that trade. I had room. You have to make sure there's room, especially if it's a riskier trade. And there was a potential of a 1 to 5 risk to reward, right? I could have gotten, if it really would have rolled over, I could have gotten 5 points out of it for risking $1. That was the big potential. There's some traders that are risk takers and willing to set wider stops for bigger potential return. So that's Jimmy, right? Jimmy is the risk taker. Only you know if you're that type of person. It's important to know your risk to reward for each trade. You need to know how much you're willing to lose on a single trade. As a rule of thumb, you may want to consider not risking more than 1/2 to 1% of your trading capital on a single trade, right? In other words, if you had a $50,000 trading account, you would risk no more than 500 on a single trade, regardless of the capital in the position. Only you will know the answer to this question. So 0.5% would be 250, 1% is 500. You can look at it that way. So if you put 10,000 into the position, you can risk 5%. That's a big risk. If you put 50,000, if you put all of your account in the position, you better only risk 0.5 to 1%. I'm not going to go into the stops for each trade style. We're not doing a lot of swing and position trading, so I'm not going to go through any of that. But bigger trades, position trades require bigger stops. Okay. Idea to add to class. This is where the don't chase rule comes in. Sometimes we may have to not follow you guys into a trade if we haven't assessed our risk. Yeah, yeah. I mean, so Jamie, I'll tell you this. Think of it this way. You can always start really small too. If you start with a real small position, and then as you're assessing it, then if you get the opportunity, you can add more. You could always add more. But yeah, you'll have to kind of start thinking on the fly of how much you're willing to risk. I kind of always in my mind, I know, generally speaking, I don't like to risk more than 15 or 20 cents, 30 cents, on an average stock. It's, I hate to say it, but for me, it's become kind of second nature. I see it, I know. Oh, look at Jable. Jable rolled it back over. I missed re-entry on Jable. So, all right, we just have a few minutes left. Are there any other specific questions about this topic? So what I'll do is, hold on. Let me go into, I do have some trades in my, hold on. In this, these are the bottom fish. This is a demo. I have a lot of positions in here. So let me just pick one of them real quick. Here, MRO, because it's close to the current price. You wanted me to do, setting a stop and okay, so like MRO. So I'm down a little bit on MRO right now. So if I want to set a stop, right, I'm in at 230. I mean, in 230 shares at 436, right? So I click stop, sell. So if I want to go below, let's say VWAP, stop, go a little lower. So I'm risking $48. So there's my stop. I mean, you kind of see every day how we're doing our. I mean, I'm showing every day, putting in trades, and um, I'll tomorrow we'll focus a lot more live when I'm in live. I'll do some more bracket orders on trades, so you can see exactly where I'm setting targets and stops. That'll help you out. When I set a limit, I get a warning that I'm overselling. I don't know what would cause that. Overselling. Well, like you would set a limit up above to take profit. So if I want to take profit, I would go up above because I'm long. So my limit would go up here, up above the current price, right? Dan, get with me later, and maybe I'll get with you to figure out what the problem is. It sounds like you're doing something wrong. All right, I want to thank you guys for tuning in today. I hope y'all have learned something, and market is closed, so that's it for today. I did record this session, so I will be posting it up on our YouTube page. If you have additional questions, don't hesitate to email me. If you want a copy of that document with all my trading tips, just email me, kip@equity-alerts.com, and I'll be happy to send it to you. But thanks for tuning in. Have a great evening. I'll see you guys in the morning. Bye-bye.